All right, good morning, peoples. Let's jump in here and get Coin and Coney. I've already done Misty and Tesla for you. So what did we have happen? Well, it's back and forth, right? You see, back on Friday, we had moved up to 196. Then on Monday, we moved down to, this is in Coin, back to 191. Now we're back to 197. So it's good. We're getting close, though. We've got over half, slightly above 50% of our contracts, this big number, are at 200. And then we have a smaller amount, okay, but added together, they're almost as big, okay, at 202 and 207. But let me look on the weeklies for the exact details. This isn't a good place to find it. Um, so we don't want to get above 200. As much as we want the synthetic to do well, we just simply don't want to lose on these. So here's the breakdown. It's the 207.50 and the 202. So that gives us 17,000. So this is actually slightly below 50%. So call it 48% here, 52%. And we got a little bit of running room, but not a lot. Let's make sure that's the right number. I think it's 197. Yep. And this is same thing. This is 1561. There we go. Okay. So that's great for Coney, starting to come back up. But unfortunately, when these weekly calls are written, I really hope that YieldMax figures out another strategy. I've heard talk of spreads. Spreads are a way where you don't make as much money, but you only lose what you bought it for. Essentially, it costs these guys, when you write a naked call, they call it a covered call strategy, but when you write a naked call, other than the commission fee, the number of contracts, it's pennies, few dollars. And then you get handed a bunch of money. Well, what do you have? You have a liability. So when it works, it's great. It's like you're kidding. I wrote this at 200 and it was, 191 and only went to 198. So I got to keep all the money. Fabulous, right? You went up 7 points and you got to keep all the money. But they consistently, seemingly, are writing these very tight. And what we mean by tight is very close to where the current price, 2-3% above. And some of these, coins and MSTRs and these underlying cryptos, and sometimes your NVIDIA, your big high performing NASDAQ stocks, Tesla, NVIDIA, they move. And when they move and go past, not only did you have to give back, say you got 10 million. Again, the amount is a function of how many contracts and what the dollar amount of the premium you wrote. But let's just say you were handed 10 million for a bunch of naked calls. Well, if you go way past that strike price, not only do you give them back the 10, you give them another 10 or another 15. Basically, you can give them everything that your synthetic is long. So it's like it didn't go up at all, but it did go up, right? I mean, the stock price went way up and you're all excited. Yeah, go. No. So this is a dangerous weapon, right? And you're doing it every week. How many times are you going to win? And then what happens is when the stock goes down a little bit, you win every week, right? So it goes from, I'm making up a price. Say the underlying is 190 and you wrote a 195. Well, it goes to 186. Well, of course you won the weekly, right? You got all that 5 million, 6 million. But you may have lost 14 million over in the synthetic. So you can't do that for long. But, the perfect world, well, I'll explain to you why it can't ever last. The perfect world is it goes up 1% and you're writing your naked calls out 2.5 or 3% above that price. You're collecting all the money and your synthetic made you a little bit of money. So that's the perfect world. A flat stock is okay, right? It goes up a half a point. It's $90 and it goes to 90.5 and you wrote a 93 call. Then you're collecting all the money and you're not really going down. Slightly down is okay. But if you think about what I'm describing a non-volatile stock, right? Something that's $90 and it rarely does anything but go to 89, 90 or 91.10 and it just, well, guess what? If it did that for 4 months, that IV would drop to nothing and there would be no premium in the options, right? So it's something that doesn't work. So they're selling us on the premise that they got this cool thing. And when it works, it's absolutely cool. But you got to recognize it's not going to work that often, quite honestly. I mean, now that I've been doing this for quite a while, and I understand options very well, I put on my own combo. They're called combo trades, really, when you do it in retail, but they're synthetics. It's just the actual option term is a combination. It's a put and call combination, and you adhere to the rule to make it 100% long by using the same expiration and the same strike price. So you can do a combo that's not exactly a synthetic long. And then a synthetic short just involves puts and it reverses, and there's one or two other little nuances. So they're great tools, but they can frustrate an investor type. And so it makes me look at it. And I hated when people used to say erroneous things. Well, you got 100% of the downside and only 15% on the upside. Well, it's not entirely true. If the stock just goes up 4% every week, you've got 4 times week one, 4 times week two, 4 times, right? You're eligible to get all that. But when it goes up 25% and you wrote it 4% above the current price, you're screwed, right? You lost a lot. You lost everything your synthetic made. So these are tools that can work, but they're not just magic bullets, right? There is no magic bullet. Your risk is that underlying in it. Not only is it the underlying, so when you're in a growth stock scenario, you just simply buy the stock and you wait, you get no income. So people really want income. I get it. I'm attracted to it. I like it. But it starts to make me say, well, I'll just write my covered calls. I'm in a MSTR right now because that 10-for-1 split let me, more easily buy a couple hundred shares and then write a couple of contracts out there. It's work. You got to watch it. You got to do it, quote, active management. But don't just think this works, because when it turns into a, slightly bear market and goes down, we've all seen that. Tesla's the poster child, right? So the stock went from, 220 back down to 100. If you do that over 3, 4, 5, 6 months, you steadily decline. You're picking up a little income, but you're getting killed in the NAV, and you go in and get a reverse split. And then here's what's dangerous. Okay. Now you go, okay, well, now it's going to go up. Sure, it goes up, but it goes leaps and bounds up, and it runs by your weekly. So you're not capturing all that gain. You'd have been way better off in a growth stock. And I'm not trying to position you in a growth stock. I'm just saying this is how these work, and they got to thread the needle to really be great. And that doesn't happen that often. So I don't have the perfect answer other than somebody like me that can be a swing trader and write options and understand them, right? I wish I could just hand them my money and know that I'm going to get 100% return. And so you guys that are going out there and projecting out, I'm doing that, I'm in YieldMax, and over the next 10 years, I'm going to retire at this period of time. Good luck with that. Because you got a market that you may have a year where the indexes are down 25%. Well, what does that mean? That means the average stock's down 25%. Okay, well, I'm in the inverse. Okay, well, make sure you are. But guess what? The inverse can get capped, just like the upside can get capped. So you don't capture all the downside, right? I mean, so, and I'm not telling you they're bad. Listen, I still own some of them. But I mean, just by reporting and living with them day in and day out and my own trades and everything, I'm saying, hey, this is not something you can hang your hat on. I mean, it's wonderful that we can get 20%, and maybe it lasts for 6 months and we're happy. But I know what you guys are doing. You're like, no, I want 100%. I was in Misty and, well, there will be a crypto winter, right? There will be a period. I don't think we've hit it yet. But I think we need to go up to 125 or something in Bitcoin at some point. And then when it retraces back to 74, I don't know if they'll have an and that's what I said. So everybody will go, well, I'll just get in the MSTR inverse. Well, like I said, what happens when it gets capped all the way? So I'm just saying it's not a perfect world. And don't, I used to think, oh, okay, I'll go long the long stock and I'll go long the inverse and I'm going to collect on both. And that's a winner. Not necessarily, not so fast. Okay. That works if they're both just slightly going up and down, which is contrary to them having an IV, high IV. So what'll happen is one of them gets capped on the upside, right? And then when you're dropping down, that one gets capped on the down if it goes too much. So it's not a perfect solution to anything here, guys. All right, enough on my education, but I wanted to get that out. And the other day, I was in a bad mood yesterday, so some of my videos, I apologize if I offended anybody or something. But, I'm always going to tell you, I'm going to be real with you and tell you like it is. All right, so this is our situation. Let's go look at holding. So here we are on the synthetic. Better, right? But what's better when it's a $35 million loss? Well, on 650,000, that's 80 cents or so, right? Could be a lot worse, but that's what we have in our synthetic. But we got a month, so non-issue there, right? I'm so used to looking to these ones that expired the last 2 or 3 videos. So this one is out there, no problem. But look what's happened here. We're approaching at 197 something this 200. And guys, that's 48%, right? These add up to 17,000. So this is up there like 47% and 53%. They got a little more room, right? 202 and 207. But we're at 197 with 3 trading days. And this is crypto. This is coin. Perfect scenario would be a drop back to 199 or 191, then goes back to 197 and drops to 194 on Friday. But I don't think that's going to happen. I have a feeling that this CPI today is good news. These markets are going to move up, most all equities. Crypto, most things are going to move up and there'll be a rally. Let's see. I don't know what the number is. And if it's a bad number, they're going to move down. So anyway, we've gone from only collecting 5% because this guy's hurting us, the one that's so close. But remember how these work. Again, I'm going to do a quick education. So I'm making up, was it 197 something? I don't have it in front of me. Okay, let's just call it 197.5. So you got $2.50 that you can move up, and on Friday at expiration, you stay at 200. This is worth 0. So what does that tell you about the current pricing of this option? Okay, it's $2.50 below. On Friday, it's worth 0. They have to electronically settle, so they're going to pay somewhere between a penny and a nickel. Depends on what time and what they can get done. Okay. But that's a nice deal that they sold something for $3.35. They're only paying a nickel. But everything over $200, they give all of the 5.8 million back and more. Right? So if they got 3 something at 203, they not only gave back the 5.8, say at 203.5, they've given another 5.8 back. So that's what you call a big loss, right? And that's your danger on your weeklies, guys. And so this one, there's a better chance of them staying below. But if we end up at, 203 today, at the end of the day, then we're already above both of these guys. and we're honing in on this one. So now you understand my rants when they get 90% or 88% up on a Thursday. Just take it off the table. I don't care if there's 800,000 left and you collected 9 million and you won all 9,800,000. Your risk management, just take it off the table. What if it roars and blows by and you lose all that you gained? So that's what I call risk management, especially these weekly. They got to do them week in and week out. So use risk management. And I gave kudos to Misty. I loved what the fund manager did. It's a different scenario, but I'll give them their kudos when they do a good job. All right. So this is a better situation on our synthetic. Whoops. I must not have updated 4065. Yeah, hang on. 6345586. Apologize for that, guys. Okay. So that number should be, yeah, look at it, it's right at each other. Okay, much better with only a $35 million loss. We've been 84, 85, 54. So we're doing better, right? And we're not that far away. That's what I like about these strikes. And we've got out till 9/20. We got another, month, another 5 weeks. So that part is all good, but I really like to see us collect this money. And that means staying below 200, right at 200. All right, guys, and I'm running late. Let's go over to payments. And this is what we got, a 45-cent loss, which is not horrible, but it's still a loss. And we got a 31-cent gain on writing these weeklies. So if we lose these weeklies this week, that goes away. And then if we had to buy more, we could turn around and have a $1.30 loss if we go buy them. Because what happens, you then have a paper, you probably get to the point where you're break even on this one down here, right? This 35, that was 55 that we lowered to 35, but that's a couple days ago. So the point is, you want to win everywhere you can because that's the cookie jar. That's the payment, right? That's the piggy bank or the cookie jar to pay us. All right, guys. So that's what I got for you. Again, slow and steady, not fly up. Like I said, unless YieldMax wants to come in. But I can tell you this, they might be hesitant to go to, say, a spread, a bull spread. So they write that without getting into the complexities of an option. It's a method where you can get a little bit of money, and the only thing you lose is how much you paid. So they can go up to the cap point where they lost what they put in the spread, but they can't ever lose more than the spread. So if the stock goes up a lot, you're guaranteed that your synthetic is a winner. And if your weekly is a loser, you lose what you put up. But here's the problem. All you high yield chasers aren't going to like it. You might as well go over and buy Curve or something else. Remember, I did the Curve video and I said, these guys don't have the NAV reduction and they're doing synthetics. They're just more conservative. They write out a month. They don't write out a week. So you only have to win once a week, once a month instead of 4 times. And so what'll happen if they write 12% out for the whole month and the stock goes roaring up 14% in a week and it would have run by the 5% weekly cap, they've got time for it to come back. So they win more often on their monthlies by being volatile, going way up, but then pulling back. And at the end of the month, okay, it was up 12% and you wrote your monthly call 12% because you wrote out a month, right? Instead of trying to get 4% 4 times. So in theory, the weekly approach works better when you're winning all the time. It doesn't work so well when you get capped often. So there's all kinds of funds. And seriously, these option guys are really digging in the toolbox to try and do it. So you guys that think you can get 100% yield year after year after year, and you got it on your board how you're going to retire in 15 years, good luck with that one. that market will wipe you out way before you ever did all those things you think you're going to have. So I'm just, you know, please understand these. They're not completely a magic bullet. They're an option strategy, and they can be very lucrative at times, but that's it. They're not always going to be lucrative. So you guys that have other options, no pun intended, and you only put some monies in here and you manage it. You know, we're all greedy. If we see I can get 100% return on my money and it starts working for 3 months, what do? We go stick a bunch of our other money in there, and then that happens to be when the market reverses on us, or it takes off wildly and we get capped all the time. So just be aware, portfolio should have a mix. I always say there's a place in my portfolio for these types of income funds, but when they frustrate me so much, I'm out there doing other active strategies. Okay, guys, that's what I got for you. Again, I'm not a financial advisor. This is not financial advice. It's for fun and entertainment. Have a good one. Bye for now.